Sebastian Mallaby, More Money Than God, Hedge Funds and the Making of a New Elite. In this book's summary, you'll gain insights into the world of hedge funds, their history, and their impact on the global economy. You'll learn about their distinctive approach to trading through buying long and selling short stocks, which has allowed them to achieve remarkable profits. Furthermore, you'll explore the strategies of iconic hedge funds like Steinhardt, Fine and Berkowitz, Commodities Corporation, Quantum, Tiger, and Farallon, and uncover the fundamentals behind their successes. Through understanding the intricacies of hedge funds, you'll unveil their potential to both devastate and save economies, raising essential questions about their role in the global financial system.
Understanding hedge funds. Discover how hedge funds operate, from buying long and selling short to managing investors' capital and earning lucrative profits. Hedge funds are complex financial institutions that can be challenging to grasp for the uninitiated. One of the most critical aspects of hedge funds is their unique approach to stock market trading, which combines buying long with selling short. In simple terms, hedge funds managers hope to profit by investing a mixture of long and short positions in different stocks. To achieve this goal, hedge fund managers must carefully analyze and understand the market's dynamics to select the most promising companies for long positions and less favorable ones to short. Investing in this way allows them to manage investors' capital on a massive scale to optimize profits. This capital is earned through performance fees, which reward hedge fund managers for successful trades. A.W. Jones founded the first hedged fund in 1949, and his model continues to influence modern hedge funds today. Hedge fund managers take on a considerable amount of risk but require significant investments to operate at scale. As such, their investors play an essential role in their success. In summary, hedge fund strategy is to buy long and sell short to maximize profits while managing large sums of investors' capital. By understanding how hedge funds operate and the risks involved, investors can make informed decisions and potentially reap significant financial benefits. Hedge fund strategy demystified. Hedge funds operate through a diversified portfolio buying long and selling short stocks, offering little risk for investors. This strategy guarantees a high success rate for hedge funds as they are cautious in trade since their own investments are at risk. Hedge funds also operate without the safety net of government intervention in cases of insolvency. Betting big to win big. Steinhardt, Fine and Berkowitz were among the first to follow A.W. Jones' hedge fund model on a massive scale, and their strategy of betting big to win big paid off. They flourished in the 1970s when large stocks were offered at steep discounts, making huge profits through well-calculated risks. Their success was not due to luck but skill and strategy, enabling them to thrive while other hedge funds went bankrupt due to inflation. Commodities Corporation, the science of finance. Commodities Corporation, a hedge fund giant, revolutionized A.W. Jones's original method by introducing a scientific approach to financial trading. The firm's president, F. Helmut Weimar, placed bets on commodities using deep analyses to predict market changes. However, Weimar's overconfidence in his method almost led the firm to bankruptcy when corn blight hit U.S. fields. They managed to recover by shifting attention to analyzing financial conditions and researching investor psychology. They exploited an investor's tendency to buy when a stock goes up and sell when the price falls, creating a snowball effect and increasing their capital from $1 million to $30 million by the end of the 1970s. George Soros, the currency maverick. The story of George Soros and how he revolutionized the way currencies are viewed and traded on. In the 1980s, George Soros founded Quantum, a hedge fund that brought about a new era in trading currency. At the time, the dollar was seen as a stable currency with no likelihood of crashing. However, Soros didn't view currencies as stable entities and instead decided to trade currency itself. To do that, Soros first began to understand how different factors like politics or capital movement could impact a currency's value. In 1985, he made his first big currency trade, anticipating the dollar's fall and buying short US dollars along with other stable foreign currencies. Even if initially it seemed his predictions were off, on September 22 that year, the US, West Germany, Japan, and UK Treasury secretaries chose to push the dollar's value downward. As a consequence, Soros made a commitment of $230 million in a single day, from a political decision, also gaining a fortune from that event. Eventually, Soros would be the one to have an impact on these events himself. George Soros' significant contributions to the hedge fund industry cemented his stature in the investment world. His insight into the fragility of currency trading transformed the way currencies are viewed and traded to this day. Julian Robertson and the birth of Tiger Fund. In 1980, Julian Robertson founded Tiger Fund, which broke the conventional approach to stock trading. While most firms relied on complicated formulas, Robertson and his team sought misvalued stocks and traded them, resulting in huge profits. They analyzed all relevant information, including the company's prospects and currencies and commodities that could impact the stock's value. For instance, the fund identified undervalued shares of Avial and Empire Airlines and sold them later at double the price. Their success revolutionized the stock trading industry by emphasizing the importance of stock picking. Robertson's straightforward approach proved that disregarding influential information often disregarded leads to missed opportunities. Farallon, the hedge fund that prioritized accountability and fair risk distribution. Farallon, founded by Tom Steyer in 1985, made a significant contribution to hedge fund practices by prioritizing accountability and fair risk distribution. Rather than solely focusing on performance fees, which could lead to traders making overly risky calls, Farallon made traders accountable for their losses by having them keep their savings invested in the fund, ensuring they felt the pain if they made bad bets. This approach led to Farallon's success and impressive reputation, with even Yale University investing in the fund. Farallon's focus on integrity and fair risk distribution offers a valuable lesson to the hedge fund industry. The power of hedge funds. Hedge funds possess massive influences on the global economy due to their capability to invest enormous amounts of money fast. They can create economic devastation or save economies, depending on their actions. George Soros, for instance, became $1 billion richer by short-selling the sterling after the Berlin Wall collapse in the early 1990s. In contrast, Farallon lifted Indonesia's economy by more than 500% by buying control of Bank Central Asia in 2002. Hedge funds' global reach can turn the international community's attention to their investments and set off a domino chain of events that can ultimately lift up an entire economy. Hedge funds, the good, the bad, and the stable. Hedge funds are often viewed as a threat to global economies and governments. However, like any other firm, hedge funds can take different forms, and some are less dangerous than others. Despite the perception that hedge funds engage in financial fraud or abuse more than other institutions, no evidence backs such a claim. The financial crisis of 2007 to 2009 proved that financial institutions are not entirely safe, and no amount of regulation can guarantee their security. Hedge funds can be dangerous, but the one main benefit they offer to the public interest is that they cannot become too big to fail. Although hedge funds have profound influence on the economy, just like any other major financial institution, unlike banks, their failure is unlikely to result in catastrophic financial loss, making them potentially stable factors.
In conclusion, More Money Than God offers an in-depth, informative, and engaging exploration of hedge funds, their strategies, and the financial luminaries who shaped them. By examining the methods of various successful funds, such as buying long, selling short, thoughtful stock picking, and innovative risk management, we can grasp the foundations of hedge fund success. Despite their potential to threaten whole economies and governments, hedge funds also have the capacity to improve nations' financial fortunes. On balance, hedge funds are not inherently more dangerous or fraudulent than other financial institutions, yet they possess a unique attribute: they're not too big to fail, which can act as a stabilizing force in the global financial landscape.